Good morning. My name is Carlo Martuscelli. I'm European economy reporter for Politico. When the Draghi report was unveiled in Brussels about a year ago, it looked like something had finally clicked. Anxieties over long-term European decline had been growing for some time. Then came the savior of the euro, of whatever it takes fame, with just the prescription. Capitals, from Paris to Rome and Madrid, rushed to praise its conclusions. Technocratic, yes, but goal-oriented, spelling out a concrete vision that spanned energy markets, industrial strategy, and the financial system. 1 year on, and it's fair to say that progress has been slow. The twin threats of a revisionist White House and Russian advances on Europe's Eastern Front have sapped momentum from the reform agenda. The revamped Capital Markets Union, called the Savings and Investment Union, hasn't seen much progress so far. Of course, change takes time, and in Brussels, 12 months isn't long at all. But as Mario Draghi recently warned, unless Europe takes action, it will find its relevance on the international stage progressively fading. We are here to talk about this and more. A brief reminder to please give us some publicity on your social media of choice, LinkedIn, Twitter, Blue Sky. Tweet the best quotes out, much appreciated. Now, without further ado, I'm delighted to welcome Luis de Guindos, Vice President of the European Central Bank, for a short interview on how the ECB is navigating a world in storm. Mr. Vice President, thanks so much for joining us virtually today. You are leading a task force on banking simplification with the ECB and the central banks. As a first question, I wanted to ask you, why now? Why banking simplification? And how does it connect to the wider capital markets savings union project that the Commission is pushing forward?
First of all, good morning. Thank you very much for the invitation. My apologies because I cannot be in person with you because of reasons of force majeure. Why simplification now? Well, at the beginning of the year, the Governing Council decided to incorporate a sort of high-level group in order to make recommendations to the European Commission about how to simplify the framework, the legal framework of the European banks. And it covered three main areas. The first one was the capital stack and the regulation. The second one is about reporting, and the third one is about supervision. Simultaneously, some red lines were set up. The most important one is that the capital ratios of the European banks should not be reduced. Solvency is paramount. Solvency is key, and I think that this is one of the main advantages, in terms of the position of the European banking industry in comparison with other legislations. And simultaneously, that simplification does not mean deregulation. In the meantime, we have started to make progress in order to define the recommendations that we have to make to the legislators, mainly to the European Commission. And we have reached some preliminary conclusions, for instance, with respect to the capital stack and the regulation. Now, for instance, the number of capital buffers of the European banks is above 10. It's very complicated. It's a complex issue. It creates difficulties in terms of understanding for investors. And this is something that we want to reduce. And we will make a clear recommendation in that regard. Another recommendation will be about proportionality, how to deal with the smaller banks, and how they can have a different regulatory framework that facilitates the way forward and how we deal and how we supervise small banks. And finally, there are other areas, for instance, like the stress testing. On reporting, the proposal is very simple. We are going to try to to simplify the way that banks report to the different supervisors and national authorities. We are going to recommend a single integrated channel for reporting, and finally, a common platform in order to share all the information. And finally, supervision. And this is, very rapidly the main highlights that I can tell you about, this group.
Perfect. I'm a central banking reporter, among other things, so I would be remiss if I didn't ask you at least one question about the macroeconomic environment and interest rates. You recently said that the current level of interest rates are adequate, and your ECB colleague Philip Lane said that inflation is unlikely to return to the lows seen before the pandemic. So I wanted to ask you, Vice President, how many interest rate cuts would you expect the ECB to go ahead with in the next 12 months?
Well, this is the $1 million question, no? But my response is very simple. It will depend on the data. We have been crystal clear in that respect. There is a lot of uncertainty around geopolitics, the evolution of agreements, these kind of things. And I think that we have to be prudent. That's the approach, no? But let me say something now. The present level of interest rates is the correct one, according to the main parameters that we use in order to assess our monetary policy stance. The first one is the evolution of inflation. The second one is the evolution of our projections, and finally the transmission of monetary policy. And according to these three components, three elements, our monetary policy stance now is in a good place, as President Lagarde has indicated recently. And we believe that the level of interest rates is the correct one.
Okay, perfect. And I wanted to ask you a last question before I welcome the rest of the panel, which is on non-bank financial institutions, which I know is a topic you've addressed in the past. Currently, we've seen some tremors in the financial markets linked to U.S. shutdown, a possible U.S. shutdown in Washington. There's been this move into gold. I mean, there's always something's moving in the market. I don't want to say that there's anything particularly worrying in this moment, but do you think NBFIs could be the next weakest link in the financial markets? I mean, is this an area we should be particularly paying attention to? And I'm thinking here particular about interlinkages between European NBFIs and the US market, treasuries, and so on.
Now, this is a good question. You are totally right. First of all, the growth of non-banks, they have been gaining market share, not only in the US, but as well in Europe. So the relevance of non-banks is growing. Secondly, the liaisons, the links between banks and non-banks are quite obvious. In the case of non-banks, here, supervision is lighter than the case of the banks. Secondly, leverage is very high, and there are some liquidity mismatches. So it could be a source of, let's say, potential corrections in markets. We have to bear in mind simultaneously that valuations in markets are very high. If you look at the risk premium, both in equity markets and in fixed income securities, is very, 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 very thin. Markets are taking a lot of risk. They are discounting, a very benign scenario in the near future that if it does not become real, it could give rise to an important correction that could be amplified by, the situation and, the investments and the investment strategy of non-banks. And simultaneously, there is another aspect that we have to bear in mind, that is fiscal policy. Fiscal policy in the US, fiscal policy in Europe, the challenges there are very important. And that could give rise, as it has been, in the case, for instance, remember what happened with, the situation of the accident with the mini budget in the UK, could give rise to an increase in yields that could, be, a very, it could trigger, the correction, given, the vulnerabilities that we have in financial markets.
And And when you said that markets are pricing in a very optimistic scenario, I mean, reading between the lines, I take it you're referring to AI working out, whatever that means.
Well, AI now, is something that is quite common. You cannot have a conference without talking about AI. Sometimes I think that we do not fully understand the potential implications. I think that it's going to have some advantages, but there are some risks simultaneously. But let me say something now. If you look at the discussion that we have in Europe about independence, one of the elements that we regard closely is that, many of the, for instance, cloud suppliers are not European. My concern is that perhaps in 3-4 years, we will be in a similar situation with respect to AI. So if we want to become independent, I think that investment in AI in Europe is one of the main priorities. And this perhaps links to the main theme of the conference that we are having now.
Perfect. Well, thank you so much for so graciously connecting the question to the wider topic. I now want to welcome the rest of the panel to join us on stage. So please, thanks so much. Hi. Hi. Good morning. Hi.
Good morning.
Hi. Good to see you. Okay, so perfect. I'd like to introduce on stage MEP Pascal Camfon, member of the Envy Committee and part of the Renew Europe group. I would also like to welcome Andrei Losecru-Pietri, Chairman and Scientific Director of the Joint European Disruptive Initiative, or JEDI, and Antonio Nestoras, Founding Director of the European Policy Innovation Council, or EPIC. A lot of great acronyms on this panel, so thanks for that. I thought we could just kick things off with a open question to the whole panel. We can just go around. I was discussing simplification with the Vice President earlier. I mean, obviously the Draghi report contains many, many recommendations. Simplification is just one of them, but I wanted to get your thoughts on how important do you think simplification is in the context of driving European competitiveness? I'll leave this an open question. Whoever wants to jump in can jump in. Sure, yes, okay. Please.
So good morning to all. So I would say simplification is the cherry on the cake. It's not the cake itself. Is it really, really much more simple to install a plant, an industry plant in the US than in the EU? Frankly speaking, just ask people dealing with federal regulation and state federation regulations and local regulations, not even dealing with ICE red, it's not that easy. So there is a bit of a storytelling where everything is rosy and easy in the US, everything is slow and complicated in the EU. We need to simplify, and we are working on simplification for sure, but when you look at the Draghi report itself, frankly speaking, it's not top #1 recommendations, that's what you said. So it's a bit, I would say, hiding the fact that we wouldn't agree on the rest. So what do we agree on? Well, the least common denominator, and then we focus only on simplification. And then the KPI of the implementation of the Draghi report is, do we simplify or not? Well, do we finance? Do we strategize? That's another story, okay? And that's where it becomes much more difficult to find a political agreement. And that's the core, and I conclude there, that's the core of the moment we are in. We need more Europe. We need more Europe on finance, on capital markets, and so on. We need more Europe. Do we have leaders able to conquer, to deliver what the previous generations did? Before it was Schengen, it was the single market, it was the Eurozone, and so it was other milestones on the European construction. Are we in the moment where, politically speaking, leaders could agree on this. That's the real question, because then it will drive the change we need.
Are we?
The answer is, as we speak, frankly speaking, no. And the risk is that we will be less and less. Why? Because of the rise of far-right parties that, of course, cannot deliver more integration at the EU level. So that's why it will become more and more difficult, and that's why we need this moment to do it. Just a conclusion. Just ourselves, we should be careful not falling into the trap of the very bad narrative around Europe injected by ourselves. When you look at the share of industry in the EU and in the US, in the US, 17%. In the EU, 22%. So I'm not saying that everything is rosy in Europe, that we are industrializing as much as we should, obviously, but just compare the reality. We are still much more industrialized than the US. So if the opposite was true, that it would be so evident, so cheap, so easy to go to the US, then of course the reality might be different. And then last point is the use of euro, because we have the vice president of the central bank. We should use more the euro as a power tool. We should provide more swap lines to other countries. Recently, Brazil said, well, I want to diversify my risk compared to the dollars, but I need swap lines with the euro, so I need swap lines from ECB. Are we providing swap lines that would allow us to raise the euro as a global currency reserve currency? Are we or are we not? Okay, so that's, to my view, are the key challenges. Draghi knows that quite well as well, obviously, that, to my view, are much more strategic than the simplification per se.
Carlo, if I may,
Please.
Just a few comments. I wouldn't disagree with Pascal that simplification is just one part of the Draghi report, but I would differentiate myself on the possibility that the far right or the rise of the far right or the far left of the Eurosceptic is the biggest concern in the industry when it comes to competitiveness right now. The best way to protect the European project and the European idea from the rise of Eurosceptic forces would be to make integration more effective for the people and for the purposes, more fit for the purposes that we wanted to achieve the goals that we wanted to achieve. So simplification is not everything in the report, but we have to give the industry something in return for being so socially responsible and so environmentally aware. Throughout the past 5-10 years, and I'm 100% confident in what I'm saying, we have managed to create, with all this regulation, the most socially responsible and most environmentally aware industry on the face of the planet. This is Europe. European products are the most sustainable and the fairest products in the world, right? So we have to give them something, at least to support them, if not with reporting and simplification, with exports and with being more competitive towards the global competitors of Europe. So if we make that possible, if that is something that Europe achieves and is effective in, then I don't believe that the concern of the far right or the far left would be, so disruptive for European politics and the European industry.
Maybe, good morning, everybody. A slight parallel comment on that. We talk simplification, but actually, it's like when you talk about politicians, you need to talk to the heart and to the mind. To the mind, simplification is actually, a lot of the Draghi report is about scale. It's the unified market because you need the scale. It's scale for technology or research investment. It's scale if you want to be a geopolitical power. It's scale if you want to if you want integrated and really military power. And the other thing, talking to the hearts, is more results. Because simplification means also that the people understand it has an impact. And there, I agree with you, where China for the last 25 years has been fantastic. It's this self-fulfilling prophecy of announcing You know, at one point, even the Chinese government was even announcing that the stock market would go up, which created investors to come in, and the stock market ended. They created factories for clients that they did not have. The clients thought the factories were already there. So this is the self-fulfilling prophecy. And when you look at some characteristic of the US administration, it has a similar thing. And on that one, let me tell you, I mean, we are here to talk about the Draghi report. I think the Draghi report is just, for me, the symbol of the fact that the current system as we have is not working anymore, be it on the heart or on the mind. And I don't want to add to the pessimism. It's more a call for action. But no, I disagree on the fact on industry. I mean, we lost 30% GDP per capita, so it's not just about the big pictures, per capita in the last 20 years to the US. So no, our economic system, with all due respect for the European Central Bank, which is doing a great job, but they have only part of the solution, is not delivering. I just came back 3 days from Ukraine, and I must say I'm still a bit, it's probably a bit too early to draw conclusions, but I hear all these leaders talking about we are absolutely not ready. I mean, the fact that we use $40 million or euro, it should be a $1 million euro question, Mr. Vice President, not a $1 million question, to shoot down 19 drones that cost individually $30,000 is a massive military failure. I would even argue that the famous 5% that, of course, many of the countries will not achieve, my country first, France, because of budgetary constraints, is actually an incentive, talking about things that don't work, to actually, we have burning money, we need to deploy it, and currently we are deploying it in equipment that is the war of yesterday. When you talk to the Ukrainians, they tell you it's a totally different thing. On the democratic aspect, we are not delivering. I mean, when I hear President von der Leyen, again with a lot of due respect, and a frustrated Mario Draghi, you probably saw them both 2 weeks ago, and she says how fantastic the Commission has delivered, I think 75%. I mean, who are we talking to? We are taking voters and Europeans for fools. People know it's not the case. You're saying it's 12%, we say it's 14% with our Draghi tracker that has been implemented. The more we live in the illusion, and that's what Enrico is saying very well, the illusion of the common market, we are going to make people flee to the extremes. And that's, by the way, the whole message of this cap is we need to be more radical. And last thing, we're failing on values. Where's the courage? Where is the sense of urgency? I mean, the fact that 1 year later, we have not delivered, is actually showing that these institutions, Commission, Parliament, councils, are not fit anymore for the world in which we are, where we don't care about the billions that President Macron or Chancellor Merz or von der Leyen will announce. It's about speed. The only thing that counts is speed. You can like or not like Pete Hegseth, but that was the message in his message to the generals yesterday, which was a crazy video that you... We need to change, if we want to keep the European idea, if we want to have a green sense of hope, we need to change. Otherwise, in a couple of years, we will have Eurosceptics everywhere because they see it's not delivering. So I think Draghi is an example. I mean, the fact that there is the omnibus law has so much difficulties to pass. I mean, I don't know how many commissions have been set up to implement the Draghi report. Does anybody realize the crazy paradox of that? So I must say I'm very, very worried because industry is leaving, that's for sure. And if we don't act not in months, but in weeks and days, I think the European idea is a dead idea in a couple of years.
I wanted to pick up on that point about scale because it's something I noticed in the Draghi report as well. It seems to me that if the US growth model is based on enormous pools of capital and low regulation, at least in some areas, that allows businesses, especially in tech, to launch and scale up very quickly. The Chinese growth model is based on the state basically pouring enormous subsidies to develop high-end manufacturing, maybe suppress household income as well. I mean, my question is, and I think this is something the Draghi report is trying to answer, is what does the European model look like? Is it striking a balance between the US and China? Is it something else entirely? So it's a rather abstract question, but I think it's quite important when discussing the Draghi report. You know, what does European growth, technological development scale, you know, continental scale, because we are talking about a continent. What does that look like? I'll put the question to the panel again, whoever wants to jump in.
I can start again, okay? That's, to my view, one much more strategic issue than simplification. Again, I'm not, nobody's against simplification for one good reason, that if you want to reach your goal, it has to be simple. So I am in favor of simplification. For instance, I am negotiator of the 20th regime in the parliament to make sure that when you create a startup and you want to scale, you do not have to recreate 26 other subsidiaries and so on with different regime, blah, 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 blah. So we need to be more simple, that's for sure. But it's one piece of a more strategic agenda. And the risk I see is that it's the tree, and then we discuss only the tree and we forget the rest. And both of you mentioned the scale or the engine behind the growth model and the prosperity model. And then that's why, obviously, financing is key. You cannot finance, you cannot grow if you don't finance. And then you have the two pillars of the Draghi report, and the two pillars are equally important, and that's why we need to depolarize this issue, which is not the case today at the leaders level, is capital market union. To make it very simple, of course, we could be much more granular, but to make the private investment flowing to European companies more rapidly, more swiftly, more efficiency, and so on, but you know that by heart, to finance innovation. Second, public money with higher rolling over the debt, which is the Draghi proposal, or new something, or a bigger MFF. I mean, then it's about technicalities. Of course, there are implications in various options, but at least we should be able to agree on this part of the Draghi report, financing, private and public. And that would make a massive difference. Would make a massive difference also in the perception, as you said, in the storytelling, in the capacity to fulfill our objectives. Because we would know that at least on this key element, we deliver. And it's not the case yet. Mm-hmm. On the public side, just look at the debate we are going to have on the next MFF. And on the private side, under the umbrella of Capital Market Union, and I am a big fan of that, each capital is starting to renegotiate for its insurance companies, for its pension funds, for its banking industries, for the part of the banking, blah, blah, blah. And you know that by heart. And I must say that on this part, I don't see any change. I agree with you. I don't see any change. I don't see any different mindset to say, okay, this time I understand that I need to create a common good, which, okay, if I lose one part of the segment of the market for a French bank, at the end of the day, everybody will be better off. It's not there. It's not there.
Can I argue on the fact we always hear that, especially in my country, but I heard that also in Germany, which is my second home country, we need a third way. I would argue that actually the US and China, having lived, when you live 10 years in China, you often say when you stay a day, you write a book, and when you stay longer, you don't really know because it's such a complex country. But there are two characteristics which are actually very similar. There is ultra competition. Look at the telecom industry. We always think, yes, there is this Chinese champion, and so the French want to create their own champions. That's not the case. There was fantastic competition between the ZTE, the Huawei, and once the one emerged from brutal competition, market-driven competition, then they went out. Same in the US is happening right now in AI that we just talked. So that's the competition part is very strong. The role of the state is not putting money like here. I see this dream in Brussels about investing in European champions. Public money in private investments has always ended bad. The public money needs to be focused on topics too risky for the private side. That's what the Chinese are doing at the beginning when they funded massively the battery industry. That's what DARPA, which is our model for my own organization, is funding topics, the so-called moonshots, which are too risky. But when I see, bureaucrats that love to become investors, this is currently happening with the EIC or things like that, you should kill these things immediately. We are spending money. In France, we have a program called France 2030. The president had the right vision. Let's do priorities. What did we do? 7,500 projects. Horizon Europe, of course, great program. 37,000 projects. How can you have priorities? How can you evaluate? How can you stop what does not work? No, it's spreading money everywhere. So, of course, you have a lot of people who support that. So that's my second point. And the third point is technicality, competence. We need much more competent people within government. We see that, obviously, in China, which is absolutely not the model for me. When you see behind the cloud of what you see at the White House, you have still very competent people at NIH or at research organizations. When I see what we did, on electric vehicles, where all the industry was saying, right on the moral ground, but you're killing our own industry. We do the same with AI factories. When you talk to AI people, they tell you this additional money is just going to be public procurement with European taxpayer money into NVIDIA. I mean, we need to call that as a huge scandal, and we need to focus on the real priorities and create the future and not try to always catch up with the others. So that would be my comparison. I don't think we need a new model. We need to do what works in the world of today.
I wanted to pick up the point on financing and scale and ask the Vice President, one thing that Draghi has often repeated is this need for European joint borrowing. I mean, on the kind of, if we want to call it the demand side, that can help finance, whatever industrial projects, infrastructure, et cetera, et cetera. But I think maybe even more importantly, he's looking at the supply side, which is creating a pool of European safe assets, something that can rival the US Treasury market. I mean, I think now with the recovery fund, the European joint borrowing outstanding, let's say EU joint bond pool is at around $500 billion, if I'm not mistaken, double check that number. US Treasury market is at, I think, 27 trillion. So that's a 50 times difference, more actually. So I wanted to ask you, Vice President, where did you stand on this issue? I know there was a paper that proposed, rather than doing more joint borrowing, mutualization of existing European debt as well. So if you had thoughts on that.
Well, I think that this is an important point. Let me say something. We are dedicating a lot of attention to the Draghi report, and I think that it deserves that attention. But we cannot overlook the Letta report. I think that the Letta report is key, in the sense that it focuses on the single market, and the single market. I think that is going to be crucial for the capital market union. If you do not have a single market for goods and services, it's going to be extremely, extremely difficult to have a real capital market union. And, with respect to the capital market union, we have a lot of talk and very little delivery. And I think that, because you refer to the safe asset and these kind of things, no? But if you look at the capital market union in the European Union, you realize that capital markets are fragmented. And the consequence is very simple. The cost of trading and post-trading in the EU is higher than in the UK or in the US. And this is because there are, let's say, national regulations that impede the integration. So I think that in order to have a real capital market, we need two things. The first one is to make progress in the single market, and secondly, to start to eliminate national discretions, national regulations that impede to have a real capital market union in Europe, with costs similar to the ones that you have in the US or in the UK.
Okay. but so joint borrowing for now, leave it where it is.
No, joint borrowing, if you allow me to say, it was used in the case of the New Generation EU Fund, and I think that it was a great progress. Simultaneously, I think that we have to go to the fiscal situation in order to understand joint borrowing. The fiscal situation now in Europe, the average fiscal deficit is around 3%. The public debt ratio is 90%. It's much better than in the US. But simultaneously, we have to increase, and this was part of the previous panel, we have to increase defense spending. And we have to increase from 2% of GDP to 3.5. How are we going to do this 1.5? I think that without, let's say, a common funding instrument similar to the New Generation EU Fund, I think that is going to be very difficult, and it will be almost out of the question to score the circle.
Perfect. Okay, thank you, Vice President. Antonius, I did want to get your thoughts on this discussion so far, maybe from a more quantitative perspective, because we've been speaking a lot, in political terms or in, technical terms about what Europe is doing wrong. But when you went to look at the implementation of the Draghi report in a kind of quantitative way, what did you find? And, are we doing as badly as maybe it feels?
Well, I think we all agree that the progress is very slow. That's sort of a wide consensus. You can look at it as the perennial question of whether the glass is half full or half empty. But what we did with the evaluation, the panel expert, and the Draghi Observatory Implementation Index, the famous by now 11%, is to just put a number on the thoughts of everyone, including Mario Draghi himself, that there is a lack of urgency. The most urgent and the most important measures that were recommended in the report, especially when it comes to foundational sectors like energy, for example, they were not implemented. So
0% fully implemented in energy, if I remember your report correctly.
Exactly. We fully understand the challenges and the complexities of the policymaking environment in Europe. It's multidimensional, a lot of different dynamics and so on. But nevertheless, we cannot close our eyes to what we see. And two more comments for the previous speakers. Because you mentioned joint borrowing, although the Vice President avoided to speak about it.
I think he said for defense, we needed joint borrowing, if I interpreted
it. It also needed for the full implementation of the Draghi report. Let me be absolutely clear. If we're talking about the implementation of the Draghi report, it cannot be implemented without joint borrowing. And that's a main controversial aspect of the report, which not everybody likes. We have to also understand that.
Chancellor Friedrich Merz, for one.
Yes, it is controversial. Changing the state aid rules is also another controversial aspect. We cannot have affordable energy under the current circumstances without changing the state aid rules. So on and so forth. There are different controversial aspects of the report. But nevertheless, the report is not the usual Brussels ritual where you just have something published and then discussed and then forgotten, because it was, it was commissioned by the EU, it was endorsed on the highest level by the President herself, it was written into the mission letters, it was written by the hero of the savior of Euro. So we're talking about a complete political program. That's the difference between other reports, compasses, strategy documents, and so on. We're talking about a political program that everybody, or a lot of people, are expecting to be implemented. It has created expectation. If it is not delivered, it will be a liability for this Commission. That's why by creating the Draghi Observatory and Implementation Index, it's not just a critical point of view towards the Commission, it's also an accountability mechanism. If you've promised, you pledged to implement this report, then we will monitor the situation, we will track the progress, and we will let everyone know. It's an accountability and transparency.
MEP Canfin, just briefly, he had asked me, and then...
One word on energy. when you ask companies what is the most important factor for location or scale or reinvestment, it's energy price.
Yeah, it's not regulation, it's energy.
Exactly. Fine.
Not
Good.
even taxation.
That's very important. It's energy price. What are we doing as a whole, as EU, to reduce energy price close to zero? And it's high time that we create, like we did for the Eurozone, maybe not all the countries will be in, but a really integrated electric system, power generation, distribution, network, blah, 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 system, where we collectively decrease the cost and we take advantage of nuclear from France, from renewables from Spain, and so on. And instead of putting obstacles everywhere, including from my country, of course, we create a real integrated energy single market that will decrease price. Let's do so. Let's do so. Where is the conversation? Where is the political will? That's a really, really challenging issue.
Well, you could say, where's the political will for I think the Vice President totally spot on when he says Letta is probably even more important than Draghi. Look at this capital market union. The Germans want it, the French want it, but when Commerzbank, which used to be a rotten bank and which is not that great, is now acquired, or tentatively acquired by Italians, suddenly it becomes sovereign. It would be the same, I'm sure, for Société Générale, which is probably the first that will fall because it's the weakest from the big French banks. I remind you that Santander and BNP are 7 times less valued than JP Morgan. So we are hitting ourselves in the foot, and here the member states and their regulator, the banking regulator, have a major responsibility. Second thing on energy, I make a comparison which has some importance. 80%, the revenues from the Russian shadow fleet on oil is 80% of the Russian war efforts. So energy matters. And it seems that it was a tanker that actually was used to send drones over Copenhagen. I mean, where is the action here? Our citizens are watching. And last point that is probably a bit controversial is I think we keep talking about the billions. Let's not forget we have half of the budget of the US military, all 27 together, with the UK, and we have probably 10% of the real capabilities. So it's not a question of billions. It's a question that it's totally inefficiently managed. I would argue it's the same for research. We put 95 billion in Horizon programs, but it's, as I mentioned before, totally spread with little impact, maybe except pockets like ERC. But we have bureaucratized that. So I think somebody would have wanted to paint a target on the back of Mario Draghi. He would have focused on the famous 800 billion, because then, of course, everybody would say, oh, joint borrowing. Let's first already do the hard work of simplifying. I don't see any will of simplification here. I don't see any will of simplification. Even the Germans are not able to push back those who are against the 28th regime, which are the notaries. No, screw the German notaries. I mean, where is the political courage? I mean, I think, and the fact that there is no impact-driven assessment of the Commission, I come back to Horizon. The ones who do a half-life impact evaluation of Horizon program is a so-called independent commission named by DG RTD. Of course, they are super independent. We need to do more of these trackers. Civil society needs to step up and put politicians, frankly speaking, I see some people from business here, a CEO that would have implemented 12% of a plan that is called existential would have been fired by now. I don't see any personal changes here.
Well, I didn't think I'd hear the words screw the German notaries on this panel, so it's always
sorry for my French.
Pleasant to be surprised at a Politico event. We are finishing our time, so I do want to thank all of my guests for that interesting, at times even very impassioned panel. I mean, what I got from it was a few key points that have solidified. The first is scale, that what the Chinese and the Americans have is just huge, whether pools of money, pools of technocratic capabilities in the case of China and Europe is a very big place as well. We forget it, but it is a continent. So really trying to build that scale, build that speed, because we do things slowly in Brussels. Anyone that's ever followed a trilogue knows how slow that can be. And finally, this point on simplification slash, I'd also say concentration, to take that scale and to use it methodically, to apply it at the choke points, and to really drive through change. And maybe really then the final point is a political point, which is what makes me most pessimistic about everything we discussed today, is that at the end the problems are always political. I mean, if money is spread out in 36,000 buckets, there's political reasons for that, right? That competing interests have to please their stakeholders. So let's hope that changes. Thanks again, everyone, for that really, really good panel. Everyone in the room, please stay seated, because we're going to have our Laura Greenhall on stage moderating the next interview with our partner, Revolut. Thanks so much. And thank you.